Hello, everyone, and welcome to today's Friday with Vistage webinar. Before we begin, I just want to go over a few items to help you participate in today's event. If you're experiencing any technical difficulties joining the webinar session, you can dial support at 888-259-8414. That's 888-259-8414, or you can send me a message in the questions pane of your GoToWebinar control panel, and I'll respond to you and resolve that one-on-one. When you joined today's webinar, you selected to join either by phone call or computer audio. If for any reason you would like to change your selection, you can do so by accessing your audio pane in your GoToWebinar control panel. During the presentation, all participants will be in listen-only mode. You do have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. Since we have several speakers today, when you enter your question, try to direct your questions to the speaker you wish to address it. You may send in your questions at any time. We will collect these and address them during the Q&A session at the end of today's presentation. Please note that a PDF of today's presentation is available for download in your control panel in the Handouts section. You can just expand that Handouts, click on the blue link, and download it to your computer. A recording of this presentation will be sent to attendees via email within the next week. All right, I would now like to introduce the moderator for today's webinar, Vistage Director of Research, Anne Petrik. Welcome, Anne. You now have the floor.
Thank you so much, Sarah. So Vistage Research, our goal is to provide leaders of SMBs, small to mid-sized businesses, with expertise, whether it's research, data, or perspectives on the issues and decisions you're making about your business in terms of how you optimize your business or enhance your personal leadership. And so today's session is a webinar, taking place in a webinar. We also publish research notes, ebooks, and other reports that you can access to gain these kinds of insights. So our objective today is, because tax reform has been such a big topic since its passed last fall, is to provide you with some expert perspectives on some of the decisions you might need to make as a leader and actions to take across the year to be able to really take advantage of some of the changes. So we have assembled an expert panel today. So I'll introduce them briefly, and in order to maximize the time, then we'll jump right into the top questions asked by leaders of small and mid-sized businesses. At the end, we will have the opportunity for some final recommendations from each of the panelists, and then we'll get into the Q&A. If you've submitted questions in advance, thank you, and feel free, as Sarah mentioned, to submit your questions through the field in the panel. So first, I'd like to welcome our panelists. We've got Andy Benami, who is a partner at Tarter, Krinsky & Drogan. Welcome, Andy. Next, we have Len Nitti, who's a principal at Wilkin & Guttenplan. And finally, Robert Toby, Manager Director of CBIZ. Welcome, gentlemen.
Good afternoon.
Thank you. So we're going to jump right into the questions, and each of these has been assigned to our experts. So the first question is directed to you, Len. I'm confused about the 20% reduction of taxable income for Sub S and LLCs. What businesses qualify to take advantage of the 20% pass-through income deduction, and how does it work?
Thanks, Ann. And I guess I'm not surprised that a lot of business owners are confused, because when it came to tax simplification, if you're an owner of a business, there wasn't much simplification that happened for you. A lot of things became more complicated and advanced, and even to take advantage of some of these tax breaks that we're giving, you have to jump through a few hoops. So we'll try our best to cover that in the next 5 or 6 minutes, and if just in case I slide over by a minute or two, I'll make up for it on another question, because this one is pretty complicated. So first, I think there's a few misconceptions about this deduction that I've been experienced with my clients and talking to other business owners. This has been called by the press as the pass-through business deduction, and has also been discussed that way by a number of politicians. And I think that created confusion, where a lot of sole proprietors and single-member LLC owners were wanting to know, do I need to incorporate my business? Do I need to go out and find a partner so that I could get this deduction? The deduction is actually for qualifying business income. And it doesn't matter if you're operating as an S corporation, a multi-member LLC, a partnership, or a sole proprietorship. You qualify for this deduction as long as none of the limitations apply to you. The other misconception, I think, is that everyone's expecting, based on the way this has been publicized, that it's an automatic 20% reduction of the income for business owners, and that would bring their maximum tax rate down from the highest rate of 37% down to 29.6%. I really wish it were that simple. I really wish they would have written it that simple, but it's a much more complicated calculation than that. So we're going to try to keep it simple and still articulate some of the challenges with this deduction. So to start with a few of the basics, this is going to apply to only individuals, estates, and trusts. Those are essentially either the owner of the sole proprietorship or an owner of an S Corp interest or a partnership interest. Start with the presumption that every business is entitled to a maximum of 20% deduction. It only applies to business income, so if a business also has investment income or other types of income items, that would not qualify. It also doesn't apply to wages you're paying yourself as an employee of an S corporation, or if you're receiving guaranteed payments as a partner in a partnership. The other unique thing here is that you have to do this calculation individually for every business activity that you own. So if you're someone who owns 5 or 6 different business activities, you have to go through and repeat this calculation 5 or 6 times. You can't just combine all of your businesses together and look at it as a whole, which would have been simpler. You actually have to go through and do the exercise over and over again. So there's essentially 3 limitations that will prevent some business owners from taking full advantage of this 20% deduction. The first 2 limitations, which I'm going to speak about in a minute, are only going to impact those taxpayers that are deemed to make too much money by the government. The way that the government defines if you're making too much money is it's based on what your taxable income is. So if you're a married filing joint couple and your taxable income exceeds $315,000, you're going to be deemed to be making too much money and potentially have these limitations start to apply to you. For all other taxpayers, it's $157,500, exactly half of the $315,000. There is a phase in of this limitation where if you make a little bit over the limitation amount, but not too much over, they're only going to impose the limitation on a part of your income to make things more complicated. For married filing joint, this phase-in threshold is done over $100,000, so from $315,000 up to $415,000, you don't have to consider the full limitation. For all other taxpayers, it's a $50,000 range. So the first limitation I'm going to talk about is for specified service businesses. Specified service businesses are excluded from taking this deduction once you exceed the taxable income thresholds. And it's interesting how they've defined, what a specified service business is. It's a very vague and generic definition in some regards, and to me it's designed to capture all professional or skilled service providers, with two exceptions that are very friendly to the real estate industry and architects and engineers. They can get this even though they are a skilled service provider, but others like accountants, attorneys, doctors, they would not qualify for this. But just about all skilled service providers would be out of this. The second limitation that they apply on all businesses once you exceed the taxable income threshold is what's known as the greater of wages or greater than 50% of your wages paid, or 25% of wages plus qualifying basis. And essentially how this test or limitation works is you start with your 20% deduction and you compare that to the greater of 50% of the wages you paid, or 25% of the wages plus 2.5% of your qualifying basis. And what qualifying basis means is it's going to be the original cost of the property you purchased within the first 10 years of having it in service and using it in the business, or if the property's useful life extends greater than 10 years, you'll be able to continue to include that as long as you're depreciating it. So for non-residential real property, you get to include the qualifying basis for the first 39 years you own it. For residential real property, 27.5 years, land improvements, 15 years. So you get to keep those a little longer as part of this. And, this is one that was kind of jammed in at the last minute. It wasn't in either the House or Senate packages. This was all part of the reconciliation. And this is another one that was really designed to help the real estate market and industry, because a lot of rental real estate activities, you're not paying wages necessarily, you're paying a low amount of wages. So that's where the 2.5% of qualifying basis comes in. It is important, for one thing I want to note is a lot of taxpayers who are entrepreneurial may have more than one business. And just for simplicity reasons, they may have all the payroll in one company, and then they may charge back to the other companies to be reimbursed for their employees. It's pretty clear here that the limitation is based on 50% or 25% of the W-2 wages paid by the business. So if you have this type of scenario where you're paying all the wages in one business, you may be boxing yourself out of this deduction in the other businesses since they don't have any W-2 wages. The other thing to consider is this may impact leased employee arrangements. One that I suspect will be taken care of when we get final regulations is if you're working with a certified PEO, I expect that the regulations will say that those will still be considered to be W-2 wages of the employee or the employer, similar to other sections of the tax code and regulations. So if you still have any deduction potentially surviving after these first two limitations, we move on to a final limitation, which is based on a taxpayer's taxable income. And you take whatever survived these first two limitations and you compare it to 20% of adjusted taxable income, and whichever results in the lower amount is what you actually end up being able to deduct for your qualified business income deduction. And how they define what adjusted taxable income is you start with your taxable income and then you back out any long-term capital gains and qualifying dividends, mainly because those two types of income are already receiving preferential tax rates. So they don't want you to be able to take a deduction on top of paying a lower tax rate to begin with. So I think that gets us through a hopefully not too long-winded response to the first question, and we can move on to the next one.
Okay, excellent. Thank you so much. So the second question is directed to you, Andy, and as a continuation, what legal entity would you recommend for a new business? Should a business owner consider changing to another entity type to take advantage of the new tax law?
Well, in the new tax, I mean, this is always a question for businesses from day one. You know, what legal form do I use? You know, the two sort of variables here that have changed are, number one, this flow-through deduction rate that Len just mentioned, and more importantly, a reduction in the corporate tax rate on what we call C corporations, regular corporations, down to 21%. So, you know, now you're looking at a corporation that could be taxed at 21%. Compare that to, you know, maximum tax rate on individuals, let's say through a flow-through of 37%, or if they qualify for this 20% flow-through deduction, maybe bring it down to a little under 30. But clearly those numbers are higher than the 21% corporate rate. So looking at all the, you know, the different choices you have, I mean, as an entity, you could be the LLC, the partnership, sole proprietor, you know, just a strict flow-through entity. There are advantages to that structure. First and foremost, there's a single layer of tax, albeit at a potentially higher rate currently. The flow-throughs, the partnerships, the LLCs certainly have flexibility in giving out equity interests, which is an issue for many partnerships. You want to be able to give out, you know, equity to new partners without having them incur a tax. You know, that's easy to do through an LLC. The 20% flow-through deduction that Len just mentioned also can be very valuable. In a flow-through entity such as an LLC, you can put property and take assets in and out of the entity, usually tax-free, and that's very important. Losses may flow through. They certainly flow through the entity. There are new loss limitations that will certainly limit that, unfortunately. The character of income flows through an LLC. So if there is capital gain type or dividend type income in the entity, you know, that treatment, that characterization will flow through the individual and be eligible for a lower tax rate. You know, for purchasers of, if you're selling the business, purchasers of an LLC, a flow-through entity, do get a step up in the asset basis, or, you know, can get that step up, which will be valuable to them. And in general, it's easier to restructure through an LLC form, you know, both in and out. An S corporation, which is also a flow-through, is similar, but there are slight differences. Less flexibility in giving out equity interests because there can only be one class of stock. You still get the 20% flow-through, but you cannot take assets out of an S corporation tax-free. For this purpose, they're still considered corporations, and that could trigger a tax. There's no step up, if somebody buys the assets, buys the stock, no step up in the basis. Turning to the corporation, a regular corporation, clearly many advantages in that you get a much lower tax rate now. But keep in mind, that could change. It's 21% today. There's no guarantee it won't be 22%, 23, 24 in the future. We've seen in past tax laws, rates have been cut and then, slowly inch up over the years. So that's something to keep in mind when you're doing the math. Also, a very important benefit for corporations, which not talked about, and it's not a change in the law, but there's something in the law called qualified small business stock. And for many small businesses, that is those valued less than $50 million, especially in the hands of founders, the stock of their entity may be eligible for up to 100% exclusion on the sale if they qualify as small business stock. And again, this can be a very valuable benefit. Has to be for an active business, can't be for some of the specified services, similar to what Len talked about with the flow-through deduction. But again, for many startup businesses and new businesses, this could be something they really have to consider going forward, the ability to qualify for this exclusion. Doing business through a corporation, there will not be a limitation on deductions for state taxes, at least on the corporation's state taxes, as there are for individuals. On the downside with corporations, as I mentioned before, there's no tax-free liquidation. Anything that comes out of a corporation will be taxed. Dividends are taxed to the shareholders. Any assets that come out both are taxed actually at two levels. It'll be taxed to the corporation if there's a gain, and again to the shareholders. So there is a double tax issue. Other considerations with corporations, there are many obscure taxes out there that people don't normally talk about. Accumulated earnings tax, you can't just accumulate money. Personal holding company tax, meaning you just can't incorporate passive, investment assets. State taxes can vary depending whether you're in corporate form or flow-through form. Not just the rates, but states have different apportionment rules depending on the type of entity and depending where the shareholders or members live. Another issue that I always point out with corporations and small businesses is need to consider who owns the goodwill, especially for service businesses. Is the goodwill a corporate asset or is it a personal asset? And where does that goodwill reside? Again, because with corporations, you're dealing potentially with a double tax regime. Even though there's a lower current rate, somehow these assets have to get out of the corporation one day in some form. And that's really the ultimate issue. How is the money going to come out? Is it going to be paid out as salary, in which case the corporation deducts it, but the individual picks up salary income at ordinary income rates? Will it come out as a dividend, in which case the corporation gets no deduction for dividends paid, but again, the shareholders pay a tax on the dividends? Will it, it can't never come out. I mean, at some point there'll be a reckoning and, some level of taxation. And it's really partly number crunching. You have to see how much you can accumulate at a lower tax rate, so that it can override the detriment from that second tax when you ultimately dissolve or you personally exit the corporation. Question, also on how do you change your entity to take advantage of these things? If you want to become a corporation and you're already an LLC form, it's very easy. You don't actually even have to convert the form. You can just actually make an election, check the box election to treat it as a corporation for tax purposes. On the other hand, if you are a corporation and want to change to an LLC or flow-through form, certainly if you're a C corporation, you can elect S corporation status if you qualify. But if you want to go from C corporation to LLC, that's going to be a taxable liquidation, regardless of the legal form, which in many states can just be a merger. That would be a dissolution and a taxable event, and not generally desirable. The bottom line is it's not one size fits all, and it's something it's going to involve a lot of number crunching to see when the numbers will pay off for you, if they will at all.
Excellent. I think the next question is also directed to you as well. And that's, what does a business owner need to understand about changes to the meals and entertainment deduction under the new tax law?
Okay, well, they're a lot easier to understand than the changes to corporate form. Previously, there was no deduction for entertainment or meals. They have to be connected to businesses. That's always been the case. So for entertainment expense, as long as it was directly connected with your business, meaning business was discussed before or after the event, presumably not during the entertainment event, then it was deductible. That was the theory. what is entertainment? I mean, entertainment, we generally know when we see it, it's some sort of amusement recreation event. The change, and you need to understand the change, because now entertainment will be 100% disallowed. In past years, since 1986, it was 50% disallowed as a deduction. Now it's 100%. Reason this is important is because, historically meaning 30 years, we've tended to lump meals and entertainment together because they're both subject to this 50% disallowance. So many taxpayers in their accounting systems which tend to lump them as one item. Now you really have to look at your systems and really have to separate meals from entertainment, because the meals will remain 50% deductible. The entertainment, will not be deductible at all. The question has come up sometimes, and how do we separate meals from entertainment? I mean, obviously, we think we know, but what happens if we have, food and meals are technically called food and beverages. What happens if we have food and beverages at an entertainment event? If we have food at a golf club or on the golf course or at a stadium or an arena, is that the entertainment or is that the food? The IRS hasn't told us. They haven't drawn the distinction. I think, though, what you can expect as a distinction is you have to think about the element of distraction. If you're sitting in a restaurant at a golf club away from the golf course itself, that's still a meal. On the other hand, because it's like any other meal at a restaurant. On the other hand, if you're eating the meal, at the event itself, on a golf course, in your stadium seats, because of the distraction, those I think would be considered entertainment, not the meal. The other thing you need to understand is there are, some changes to the meals rules, very slight changes. Some meals in the past were treated as what we call de minimis fringe benefits, such as the overtime, maybe an overtime allowance for employees for meals, or the coffee and the snacks given to employees. Those previously were 100% deductible, and now will only be 50% deductible. Also, meals that are provided for the convenience of your employees. In other words, you require them to be on premises. Again, now will be 50% deductible, and I think after 2025 will be 0% deductible. So, again, you can't have tax laws without exceptions to the exceptions. There are, some meals that will remain fully deductible, and the only ones will be ones you supply to your employees at social events for your employees. So it seems a bit unwieldy, but because of these changes, there's sort of fewer distinctions among meals. But you need to educate your accounting people that are responsible for categorizing your expenses to figure out what category these things go into.
Excellent. And that applies for clients as well as employees?
Well, the clients are the ones presumably it's whoever's deducting the meals or entertainment. But yeah, I mean, obviously you design your expense reports or something for employees. They need to properly categorize the items, because that's probably the first crack you have at it.
Exactly. Okay. Thank you so much. So now we're going to move on to Robert. And the question is, another provision under the new Tax Act is the interest expense deduction. How will this new interest expense limitation apply to small and mid-sized businesses?
Well, it's interesting. It depends. And, Congress did drastically lowered both the corporate rate and provided for the qualified business income deduction, and they had to pay for it some way. And this is one of two provisions that are really the revenue raisers in this bill. This is the second largest revenue raiser that's included in tax reform. And what it is starting in 2018, business interest is being limited to 30% of your taxable income after you add back depreciation and interest expense. So you take a look at what your interest expense is today, you add it back to your taxable income, you add it back to, you add depreciation back, and you multiply that number by 30, and you measure that against the interest that you've paid and you normally deduct on your tax return. And if it's over 30% of that of taxable income adjusted, then that's non-deductible interest. It's non-deductible in that year, though. The excess can be carried forward indefinitely. For corporate type businesses, whether it's an S corporation or a C corporation, the limitation is measured there, and the carryover is also applied there. For partnerships, the limitation is measured at the partnership level, and then the excess interest is passed up to the partner. There are some exceptions to businesses that to which this applies. The business has to have over $25 million of gross receipts starting in 2018. And the bill is also interesting in how this $25 million is measured. Prior to 2018, you measured the 25. It was $10 million, and it was measured over the prior 3 tax years. And once you got over that threshold, you were stuck forever using certain methods of accounting. Under the new tax law, the $25 million is measured on a year-by-year basis. So some years you might have the interest expense limitation may apply to you because you're over 25 million or more in gross receipts, and you recalculate the next year, you might not be subject to it. It's a very interesting quirk in the law of how gross receipts are measured. But of course, is always exceptions abound in this, and one of them has to do in particular with real estate businesses. And real estate businesses can elect out of the provisions of the interest deduction limitation, but there's a give back with respect to that. You have to change the depreciable lives and methods with respect to the property that you have. The lives are longer. You can only use a straight line method, and you can't claim bonus depreciation with respect to those assets that in a real estate business. With in a rising interest rate environment, this could really impact a lot more businesses than with a lower interest rate environment. And some of the calculations that I've done for my taxpayers, this has a kind of a non-intuitive answer to it, where before you were deducting interest, and now you ended up having a loss where your interest expense deduction might actually cause you to have taxable income and pay tax when you don't have operating income and you're not generating cash flow to pay it, which to me economically is the wrong answer. The other thing that I need to mention about this is this limitation is measured prior to arriving at qualified business income that Leonard talked about when you're calculating the qualified business income 20% deduction. So there's an interplay between a lot of these provisions you need to be aware of and take every one of them into consideration when you're now measuring what your taxable income actually is going to be starting in 2018.
Okay. So next question then, you mentioned Len. So Len, we'll go back to you and ask about what other loss limitations have been created or changed by the new Tax Act as they all interplay together. Len, I think you might be on mute.
Thank you. Sorry about that.
Oh, excellent. No problem.
So the government has historically been placing limits on a taxpayer's ability to deduct certain expenses and losses, mainly under the premise that they really didn't want you to be able to take a loss from one category of income and offset it with income in another category. So say they wouldn't want you to be able to take an investment loss and offset that against your earned income or your wages. So they've put a lot of limitations in place over the years. Some examples include capital loss limitations, passive activity loss limitations, limitations on investment expenses, medical deductions, and now Robert just explained another limitation, which is for business interest deductions. As part of this new Tax Act, there is now a limitation that has been imposed which targets business losses. And before we start talking about what the limitation is, let me set the stage by talking about if we were in 2007 under a particular fact pattern, what would happen, and then I'll explain how it's going to be changed. So you have two taxpayers that file together, married filing joint. One spouse is an executive for a large company, and they earn $1 million of wages during the year. The other the other spouse is the owner of a business, and because of accelerated depreciation deductions and other one-time items, they incurred a net loss from the business for the year of $1 million. So in 2017, under current law, or prior law, I guess now, these taxpayers wouldn't pay any tax because you would take the $1 million of wages and offset it with $1 million of business loss to get to net taxable income of zero. Enter 2018 now under the new Tax Act. There's now a limitation on a taxpayer's ability to deduct business losses, net business losses. And what I mean by net business losses, you would look at all your businesses together, and whatever the net gain or loss is from each business, from all the businesses together, is looked at and then potentially limited to up to a $500,000 loss deducted for married filing joint taxpayers, or $250,000 loss limitation for all other taxpayers. To the extent that you have excess losses that exceed the $500,000 or $250,000 limit, those don't disappear and get completely wasted or lost. Those become net operating loss carry-forwards. And we'll talk more about the NOL limitations in a few minutes. But to circle back to the example I started with, same taxpayers filing married filing joint, one spouse has $1 million of wages. Now the spouse that had $1 million of business losses has that business loss limited to $500,000. So where in 2017 these taxpayers would not have paid any taxes, they're now going to have net income of $500,000, even though they've had no economic income for the year. But they would have to pay tax on $500,000 plus or minus any other income items they may have and itemized deductions. So it could be a pretty significant limitation imposed on taxpayers, especially those who both have employment earnings or investment earnings in addition to business losses in any year. And I mentioned that the excess would be now treated as a net operating loss carry forward, or an NOL for short. NOLs are generally net losses created from business losses. And historically, or under previous law, we were able to either carry those losses back up to 2 tax years to get an immediate refund, or we could carry them forward 20 years to offset future taxable income and reduce our taxes. Effective for 2018, for NOLs incurred in 2018 or later, there's no longer a carryback provision in the law, so we can no longer carry those back. In order to give something back, since we can't carry back any longer, NOLs can now be carried forward indefinitely if incurred in 2018 or later. Any losses incurred prior to 2018 continue to be under the old rules. So they'd be subject to the 2-year carryback if you're in 17 and you incurred a net operating loss, or they would be carried forward for 20 years. In addition to the loss of the carryback provision for net operating losses, they're also limiting your ability to deduct these losses going forward to up to 80% of a taxpayer's taxable income, where under 2017 law, you're able to offset 100% of your income with an NOL. Going forward, it's only 80%. So taxpayers may still end up being in a taxable position based on this 80% limitation. So I think that is the only two that I want to discuss. So I think I'll turn it back over to you, Anne. Thank you.
Okay, thank you. That's a scary situation with that limitation. And the next question kind of comes back to you, asking about Section 179 and how will the expansion of Section 179 impact businesses for 2018 and beyond? Perfect,
thank you. So Section 179 provides a great opportunity for taxpayers to immediately expense fixed asset additions. Section 179 has been around for a long time now. What the Tax Act has done is essentially expand and increase the Section 179 deduction availability. In 2017, the deduction was an immediate expense of up to $510,000 of fixed asset additions. Qualifying fixed asset additions included tangible personal property with a class life of less than 20 years or 20 years or less, off-the-shelf software, and certain improvements to qualifying non-residential real property. Included in those were improvements to the interior of the building that weren't a structural component to the building, That did exclude escalators and elevators, also excluded enlargements to the building itself. What also applies with Section 179 is there are a couple of limitations against your ability to take this deduction. First one is a taxable income limitation, where in order to benefit from a Section 179 deduction, you must physically have taxable income to be able to absorb it. The other limitation is once you've been deemed to place in service too much of qualifying assets, you're deemed to be a larger taxpayer and you start to lose your ability to use Section 179. The 2017 limitation was started to kick in at about 2,030,000, and the limitation was a dollar for dollar reduction for every dollar you exceeded this threshold. For 2008, they increased your ability to deduct Section 179, and they raised it from $510,000 all the way up to $1 million. They also raised the limitation up to $2.5 million, so now you get the full $1 million up to $2.5 million of qualifying property placed in service. Once you exceed the 2.5, you lose your ability to deduct Section 179 dollar for dollar after that. The taxable income limitation remains in place as well. They also expanded the definition of qualifying real property a bit, or changed the definition of qualifying real property a bit, where they've added a few new items that can now be considered deductible under Section 179. Those are going to include roofs, certain HVAC systems, and fire protection and security systems. Again, only for non-residential real property. In a few minutes, when Robert talks about the changes to bonus depreciation, Section 179 may not sound quite as exciting, except in a certain, unique instances. But one thing I want everyone to keep in mind is in determining whether you're going to deduct Section 179 or bonus depreciation, you want to understand also what the states you operate in, how their tax law works. A number of states have decoupled from both enhanced Section 179 and bonus depreciation, but there are some states that still allow for enhanced Section 179 depreciation while completely decoupling from bonus, such as New York State. So if you're operating in New York State, you may be beneficial to want to take advantage of Section 179, even considering the new bonus depreciation rules. And I think that's a good segue probably for you to ask the next question of Robert, Ann.
That's great. Thank you, Len. And I think the Section 179 could have a big impact on our members, as our research shows that more than half of our CEOs in small and mid-sized businesses plan to increase their fixed investments. So this will definitely be a consideration for them as they look at investing in things like operation in their technology and facilities and equipment. So as Lynn mentioned, Robert, then the next question segues to you. One of the stated goals of the new Tax Act was to stimulate capital spending by businesses. What fixed asset additions will qualify for the new 100% bonus depreciation?
So fixed asset additions which have a tax depreciable life of 20 years or less qualify for bonus depreciation. Under the old law, these assets had to be new. Under the new law, they can be used assets, but they have to be new. The use has to be new with respect to you. So in other words, you can't churn an asset from someone who is a related party and it's new to you, it was old to them, and claim bonus depreciation on it. You can't do that. What's included? What types of assets that have lives of 20 years or less? Land improvements, parking lots, landscaping, 7-year property, which is desks that are used in businesses like Len's business, Andrew's business, my business. Computers, which are 5 years. Off-the-shelf computer software, trucks, vehicles. Those are the types of things that can be written off. Congress has used these provisions, the bonus depreciation provisions, for years. I mean, they used it as a stimulus after the 9/11 attacks, and they've used it as a stimulus after the recession back in 2008. Over the last, since 2001, the percentage that qualifies has come and gone and come and gone. Prior to 2018, it was 50%. Now it's 100%. One of the things that you can do with respect to bonus depreciation when you're planning along with Section 179 is you can elect not to have bonus depreciation applied by asset class. So when I mean by asset class, that's measured by their depreciable lives, whether it's 3 years, 5 years, 7 years, or 15 years. You can choose to use a straight line depreciation over those periods of time. So it gives you some flexibility when you're planning to generate income to use your interest expense, or generate income to get the 20% qualified business income deduction. So there's a lot of flexibility. One of the other things that I want to mention with respect to fixed assets, there's a waterfall that you need to decide where an addition falls under, or even if it is an addition that has to be capitalized, and then you claim bonus depreciation or Section 179, and that's the tangible property regulations, which were issued in 2014, which now change what the definition of a capitalized asset is. So when you buy something to put it into use, you have to see, first of all, if it can be written off as a repair. Secondly, if it's capitalized, and then which method you're going to choose to write it off, whether it be bonus depreciation, elect out of bonus depreciation, or Section 179 with respect to that piece of property. So this is a powerful planning tool in 2018 to help you not only bonus depreciation, but depreciation lives and methods, to help you manage what your taxable income is, to make sure you take the best benefit of some of the other limitations and deductions which are now in the tax code.
Right. So all of that is very complicated, and looking at that, and many of you have mentioned the variance of state laws and provisions, as well as some of the complexities and choices you need to make and numbers that need to be crunched. So Robert, then a lot of our leaders of small and mid-sized businesses likely rely on accounting firms or CPAs. So how might they know if their accounting firm or CPA can handle the complexity of the new tax legislation, and what kind of questions should they ask?
Yeah, it's the questions that we face from our clients every day, and what we're doing with calculating what their income is. Before I answer the question directly, I mean, what we sit down and do is we are taking their projections for 2017 and showing them what their taxable income looks like under the old rules and comparing it to what it looks like under the new rules, to go through a waterfall of choices, whether it's choice of entity, whether it's the 20% deduction, that's going to come into play with the qualified business income, depreciation lives and methods, whether they're going to have to use the accrual method of accounting now if now they're under the old rules, you had to use the accrual method if your income was greater than 10 million. Now it's over 25 million if you want to change back to the cash method of accounting. What I suggest is that business owners read articles that firms like Lenz puts out, and Andy's puts out, and my put out, to educate themselves on some of the touch points about the law, and sit down and have a conversation with their accountant to see what they understand and how they plan on analyzing what's going to happen to a client to get to maximizing the benefits and minimizing the costs under the new tax act. I handle questions all the time from people that are confused. If a practitioner is confused about the provisions, that's not a good sign. But having an honest conversation based upon your knowledge, what's come out in the press, to either confirm or maybe sometimes clarify what you've read, to give you a better feeling and a better sense that your CPA knows where they're headed under the new tax law.
And what questions specifically around state qualifications? Are there resources by state that people can look to understand? I know that all of you're operating in New York State, but looking at what are the entities at the state level that might provide some guidance.
Well, for the state law, I mean, you can go to see how the states are changing. Our firm has a website. And I encourage people to look at my website. You can go to any of the large CPA firms, recognizable names that are in your area. They'll have resources on their websites, and they've published articles that address a lot of the questions that business owners may have. And you can always pick up the phone if you're confused after you've read the article and give the people from those firm a call, or give us a call. I'm always happy to chat about these things with people and answer their questions. The state websites, you can always go to each state taxing authority's website. Some are better than others. They might provide some clarity, they may not. Also, the state accounting societies can, if you call them up, they'll be able to direct you to resources for those particular states.
Excellent. Thank you so much answering all of those questions. And before we move on to the Q&A, I know that we limited ourselves to the 8 questions that were most commonly asked from our members and from leaders of small and mid-sized businesses. But now, what final recommendations, before we get to the Q&A, and considerations, decisions that leaders should be making at the CEO level should we be thinking about? So Andy, I'll start with you.
Well, it's one thing to, again, crunch numbers and go to your accountant, but your accountant, of course, can't predict the future. I think as a business owner, you need to really think about, not just today and not 2017, 2018, but again, the long-term plan. How do you see your business evolving, growing, and how do you see your own involvement with that business changing over time? So I think you really have to take a long-term view, and armed with that information and thinking about those facts, then of course it's appropriate to go to your accountant, and obviously they can work out numbers and spreadsheets and determine really the best path to follow.
Great. Len, parting words?
Yeah, I think for me, the one thing I always tell all of my clients is that it's not a one-size-fit-all answer, especially with this new tax law. It's a one-size-fit-one answer. And trying to work with your professionals to understand what aspects of the tax law are going to impact you and how you can react or plan to get the best result out of it for your business is very important. And I know Robert talked about, what he's doing with 2017 projections and rolling those forward to 2018. Also, the perfect time to be doing it is now, while you're having your 2017 taxes prepared. Your accountant should be able to identify any areas that are maybe problematic for you, where you may lose some benefits, and have good conversations about how you may be able to correct it, or what do you need to worry about. The other important thing, or my other important takeaway from this, is a lot of this law is still gray and it has some holes in it. We really have to wait probably till the summer or fall until we start to get some tax regulations from the IRS to be able to answer all of the questions and really understand what direction they're going with in some regards. Even possibly wait for a Tax Corrections Act, which may or may not come down the pike. So I think it's important for you to be proactively working with your professionals to understand how this is going to impact you and what the next steps are for you in terms of adjusting how you're doing business going forward to take advantage of it.
Right.
Okay. And finally, Robert?
We've talked about individual provisions, and you have to look at these as pieces of a puzzle that have to be put together to make it work for you. And a lot of the nice thing is we have time to contemplate this. We have time to plan. These very few provisions were effective at the beginning of the year. They're effective for this tax year. So, take the time to work through a number of different scenarios to decide what's right for your business in the long run. Whether you're changing, you can choose to change accounting methods versus based on gross receipts now. Whether you want to go back and forth changing accounting methods, whether it's worth the time and the effort to do that. But take a contemplative look at this. And take a look at the whole. One thing that I meant to mention when I talked about it before, one of the provisions that was effective at the beginning of the year was you can no longer exchange on a tax-free basis tangible personal property. So if you're taking a truck in to buy a new truck, and you exchanged it before to get a trade-in value, you can't do that anymore if there's a gain on the old truck. You have to recognize the gain. So you have to consider now if you're buying machinery and equipment that will be depreciable, what you're going to do with the old pieces of equipment and how you're going to dispose of them. So given that's the one thing you really have to focus on as a business owner today about if you're acquiring new equipment, talk with a professional that really knows what they're doing to help you, look over the horizon to see what's coming toward us with this tax law and where it might go, and plan the financial aspects of your business accordingly.
Excellent. Thank you so much. And so we are looking at the questions that were pre-submitted now, as well as the questions that have come in during the session. And one that we've touched on a little bit is about buying and selling a business or unit, mergers and acquisitions. So how does new tax plan affect merger and acquisition transactions? Andy, could you expand on that?
Well, in a merger and acquisition transactions, you'll be talking about corporate transactions. I mean, first of all, a lower corporate tax rate, makes any corporation today more valuable since its tax liabilities have now gone down. So number one, that obviously that has some impact. It was mentioned before about reducing the net operating loss carryovers. Well, that's could reduce the value of companies with losses, because obviously purchasers may be able to use some of those losses. Again, there are a lot of limitations on that, but that certainly has an impact. Robert talked about the bonus depreciation. The ability to write off the assets. I mean, clearly, coupled with its, lower tax rate, can certainly make more attractive M&A transactions. Certainly, you'd want to do asset purchases or asset sales because, again, you're looking at a much faster write-off for the assets. On the other hand, of course, the company selling them will face a lower tax rate if they do, in fact, sell the assets. So, again, it may make asset sales more attractive. The interest deductibility issue we spoke about earlier was also going to have an impact. Obviously debt financed acquisitions have, become less attractive. So, there are obviously things on both sides that, will affect M&A transactions. And certainly, in the big world of M&A, I mean, companies who do business internationally are certainly impacted by many tax provisions, which we didn't even begin to discuss here.
Oh, thank you. A question that's a little different than anything that we've talked about today is, have charitable giving rules and opportunities changed?
Yeah, I'll answer that one. Have they changed? Now cash contributions can be deducted up to, in 2018, can be deducted up to 60% of your adjusted gross income, where prior to 2018, it was 50% of your adjusted gross income. I was meeting with a client this morning. Charitable giving, some people, because of the limitation on what you can deduct as an itemized deduction, are thinking of bunching their charitable deductions into every other year so they can get a better benefit of those charitable contributions on a tax rate basis in the years that they make those contributions. I'm still advising my clients to, if you're making charitable contributions, the best way to do it is with low basis, highly appreciated, marketable equity securities, because what you're doing is you're making $1 worth of donation that may have cost you 22 cents. So there's a lot of leverage if you use appreciated stock in making charitable contributions. My clients who are charitably inclined continue to be charitably inclined. I have not seen any changes with respect to those. It's still an individual choice in how they're doing them, but it's been made more generous, and the tax law is maybe changed the way that the timing of some of those charitable contributions.
Excellent, thank you. So another question, it's pretty specific. We're a Sub Chapter S with 5 shareholders. Looks like we'd be smart to alter the way we're being paid. We're considering lowering our salaries by 40 to 60% and taking the difference in dividends. Great idea, horrible idea?
Yeah, I could answer that one since it ties into one of the topics I covered, Anne. It depends. The IRS has a rule that is a shareholder in an S corporation who's working within the S corporation has to pay yourself a reasonable salary. So as long as you still comply with those reasonable salary expectations, you may be able to do that and lower your wages. And that may increase your ability to take advantage of the 20% deduction. The other thing to consider as part of that is whether or not you were subject to that 50% of W-2 wage test, and whether or not you're reducing your salaries would actually lower that limitation and even box you out of being able to take advantage of the deduction. So it's not a straightforward, easy answer because there's a lot of different items at play here. But the one that I think the IRS will be looking for potentially is shareholders who have significantly drop their wages, and they may want an explanation as to why and whether or not what you've done still pays yourself a reasonable salary for the work that you're doing.
And we had, it's interesting to follow on with what Len said. We had a situation this morning where the company was paying their executives high wages because they were bonusing them out at the end of the year. It's a very highly profitable company with a number of divisions. And if they would have continued along that line, they would have lost their interest expense deduction. So we're trying to weigh what a reasonable salary is to get them to a point where we maximize the interest expense deduction and maximize the 20% qualified business income deduction. There's a lot of math going on.
I heard that there's a lot of math, and the one quote I really love is the waterfall of choices, that you can't look at any single one thing, but that you have to look at the scenarios and how they play out together. All right, so thank you so much for your time today. For our experts and for our audience today, I just want to remind you of a few upcoming Fridays with Vistage webinars that we have. On Friday, April 6th, Tom Young is going to share about how you can rise above the digital noise and get high-quality leads. So we know that customer engagement and increased revenues are top of mind for CEOs of SMBs, so this will help focus on sales and how you can break through with your digital marketing efforts. And then on, Friday, April 13th, Joe Galvin, Chief Research Officer for Vistage, and business strategist Mark Emmer are going to speak on making the right decisions as a CEO. And this session will actually focus on really maximizing the investments in technology and specifically customer relationship management, and how can you not just make the investments, but actually maximize on the productivity and the things that you stand to gain from maximizing those investments. So I'd like to thank everyone for your time today. This recording will be available via the Research Center on Vistage.com, and I hope everyone has a great day. Thank you, gentlemen.
Thank you.
You're welcome. Take care, Anne.
Thanks.